Good morning, good afternoon, and good evening again. This is Joseph Trevisani from Worldwide Markets. I didn't remember where I was this time. Now, as I usually do in these webinars, I prefer to run these webinars as if I was running a lecture in a college classroom, where if you have any questions on any topic whatsoever, please interrupt, type into the chat box, and I will do my best to answer it. I don't guarantee that I'll be able to answer it, but I certainly will try. Now, I'm going to talk about emerging markets, but really, emerging markets, I'll talk about gold as well. I didn't actually plan on talking about gold or the commodities except in passing as to how they relate to the emerging markets. But I can see that this is not going to be a webinar that I'm going to be able to keep to the prescribed topic, and nor do I think I really want to. It's been a fascinating month. It's been an absolutely fascinating day since the FOMC and Mr. Bernanke's press conference yesterday. On all of the charts that I brought with me today, there's one date. Well, this one there's two, because I wanted to illustrate some of the reasons for emerging markets. But there's this date right here. Notice I do not have the date of yesterday's FOMC meeting. Because, as you will see from all of these charts, but particularly this one, let's look at this one we have here, because it serves well to illustrate what's going on. The important date was May 22nd. It was not yesterday's FOMC. And every professional trader, every hedge fund, everyone who was involved in the markets as their business started to move on May 22nd. And what day was May 22nd? Well, May 22nd was the day where Chairman Bernanke said, and you all know what he said, of course, QE could end or be tapered off. How many times have we heard taper? Not the Southeast Asian, I believe it's Southeast Asian animal called a tapir, T-A-P-A-R, but taper. Ending QE, or at least the beginning of the end. May 22nd. Almost every chart that I have here, let's take a look at the Dow. I don't think it's quite so dramatic on the Dow. I may not have it marked on the Dow. I do have it marked on the Dow. Okay, there's the Dow, May 22nd. This is the emerging markets, a much greater fall, but nonetheless the same issue. The reason is this. Well, there are no coincidences in the world of central bankers. I've spoken on this quite a few times. The utterances of Mr. Bernanke and every other central banker, but particularly Mr. Bernanke because he's the world's central banker, the leading central banker because the U.S. is the world's largest economy, is calculated. He knew, and the FOMC knew, and about everybody else knew, that the only reason for Mr. Bernanke to say May 22nd that he might possibly, why mention it otherwise, consider beginning to end QE. All of the hedging by Mr. Bernanke in his language, all of the euphemisms, all of the qualifications didn't and don't matter a bit. As you can see from this this chart, and the others I'll show you if we have enough time, because this is going to be a focused session, and we just can't get away from what's going on out there. It's absolutely fascinating. The markets are falling all around the world. But why they're falling is actually well illustrated by the emerging markets, and I'll tell you why. They're sort of like the rest of the markets, only more so. What was that? Where does that come from? He's like other men, but only more so. Oh, it is said of Captain Renault in Casablanca, the French colonial official. And Humphrey Bogart's character, Rick, asks him, or someone asks him, what is Major Renault like? And Humphrey Bogart answers, he's like other men, only more so. Anyway, forgive me that. So everyone involved in the markets knew. Though Mr. Bernanke mentioned the ending of QE on May 22nd, that's what he intended to do. There is zero reason for mentioning it otherwise. And everyone in the markets, or at least the smart people, the sensible people, operated upon that fact. Yesterday was nothing more than confirmation of what he already said. And since he had prepared the ground very carefully by saying that, and by putting some of the doubts into the minutes, and assisted, of course, although they are free agents, I don't think they are under the dictatorial rule of the chairman, other FOMC board members who voiced a number of considerations, worries, over the past several weeks. So there was really no surprise. And if you noticed, when the news first came out, when the statement was released yesterday, what were the two interesting facts that everyone focused on? One, the Fed reduced the growth parameters for this year. And they said that the economic risks have diminished somewhat. What did the markets focus on? Nobody paid any attention to the fact that the Fed had reduced growth estimates for 2013. Because nobody cares. It's not that they don't care. It's that the salient fact, the only fact that really matters, is what the Fed is going to do with its huge tidal wave of liquidity. And why does that matter so much? Because what has that liquidity been doing? Take a look at this chart. That liquidity has been looking for a home. It's been going to professional institutions, meaning hedge funds, private equity. It's not going out into the market, into the economy as loans. The monetary base has increased quite a bit. I don't actually have those charts here because we're not talking about that today. But most of it is sitting in deposits at the Fed, and the velocity of money has collapsed. So if you pump more and more money out into the economy, but it becomes more and more stationary, you do not end up with much of an effect on the economy, at least as far as monetary policy goes. So that is why everyone and everything has been focused on what the Fed has done. There are some other reasons that I'll talk about briefly here about what the Fed did yesterday, and then we'll move on to do a little bit of examination of the topic of emerging markets. But really, they're flip sides of the same thing. Because the reason emerging markets have a chart like this is the MSCI Global, let me get the exact title of it. The MSCI Emerging Markets Index. Officially, it is the Morgan Stanley Capital Index. It was started in 1988. It is probably the leading overall index for emerging markets. It has 21 countries. I could read them off for you, but they're from Brazil alphabetically down to Turkey. A few in 1, 2, 3, 3 in South America, quite a few in Asia, Mexico, South Africa, Russia, China, which doesn't really belong in this index. The second largest economy in the world, it hardly belongs here. In 1988, when the index was founded, it comprised 1% of global equity. It now comprises about 13%. In 2012, I think that's probably understated, but it is their index, so we'll let them go with it. Now, I had a little joke with myself when I was thinking about this webinar last night. It came to me that in relation to the topic at hand, meaning the world economy really since the financial crash, and certainly since the advent of the Fed's QE and low rate policy, and all the extraordinary interest rate policy of the central banks led by the Fed. There's no one who can look at what central banks have done, all of them, including the most recent Japan, and not know that it was the Fed under Bernanke that led this response. Period. Mr. Bernanke was reducing rates in 2007 in response to the subprime mortgage crisis in the United States, which, by the way, the Fed itself had said some time before is not going to be a problem for the economy. The Fed's predictions are not really any better than anyone else's. The Fed routinely has overestimated the amount of growth in the United States. So much so that their estimates are discounted by a certain percentage. However, the Fed is the only one that can act, and the Fed has acted, and it has led the world in this response to financial crisis and its aftermath. Everyone in the world is dancing to the tune of Fed policy. It's no more complicated than that. We can make all sorts of qualifications for various markets, for various currencies, on and on and on. When you look at these charts, they don't all match up. The Mexican stock market peaked in January. Let's take a look at the Bolsa. Mexican stock market is here. It peaked back in January of this year. Poland stock market, I didn't put that one up actually. Jakarta index here, peaked there. So there's plenty of variety in what you're seeing. But the dominant fact of the emerging markets, and in fact everything, has been the Fed's policies. That's just it. We can't get away from it. So, back to one or two more comments on what the Fed did yesterday, or what the Fed has been doing. Mr. Bernanke has said repeatedly, and he said yesterday flat out, that the economy is improving, and that as it improves, and conditionally on its improvement, the Fed will begin tapering QE sometime this year. Now, if you look now, maybe the Fed knows something on the economy. We don't. Two points. It seems that Mr. Bernanke is not going to be reappointed. I don't know if he wants to or not, but President Obama made it very clear that he's not reappointing Ben Bernanke. He said, I think about 4 or 5 days ago, that Mr. Bernanke has served longer than he wanted to. He meaning Mr. Bernanke. Now that was I thought at the time that was an odd thing for the president to say. And I think I put out a tweet saying that why would President Obama say this unless he had, or not unless he had, did he have prior knowledge of what the Fed was going to say? It's possible. The Fed has been discussing this for 6 weeks and more. Actually, they've been discussing it for months. So had Mr. Bernanke come to a decision about what he was going to say in the statement and at the press conference, I don't know. Certainly this will complicate politically things for President Obama, since you're seeing what the reactions are. You have a rise in interest rates, and you have a fall in the stock markets. And as this plays out over the next 6 months, it's probably not a complication that the President Obama and the Democrats, being the ruling party, largely, at least in the presidency, want to complicate their election chances in 2014. So that's a possibility. I don't have any, and I'm not sure that it matters very much, but it was odd that he said that, and at the time I thought that this meant that Bernanke was going to come out and confirm what he had already said on the 22nd. Another topic. What is happening now and has happened since the 22nd has been and was eminently predictable. Everything that has gone on, at least in the past year, since QE3 last September, not quite a year, has been dictated and determined by the market's attitude towards quantitative easing and what it means. Mr. James, I'll get to that in a minute. I'm getting to that. So once that was going to end, and, it doesn't matter, especially from a bond market point of view, but actually from any trading market point of view. It doesn't matter when it ends. Because what matters is that the markets move based on the knowledge of the next, used to be called a rate cycle. It is essentially a rate cycle. If not the Fed funds. So the Fed said. So Mr. Bernanke said yesterday that the Fed funds rate is going to stay long forever. So what? No one is paying any attention to the Fed funds rate right now, because quantitative easing is nothing more than a reduction in the Fed funds rate by other means, which everyone knows, and so everyone's paying attention to it. So just as with whenever there is a change in a rate cycle, everything moves at once, because all of the positions, especially in the bond market, have been predicated on what had been going on before. So if you're long bonds, I had some, just a personal note, I inherited some small bond funds from my mother a year and a half ago. 2.5 months ago, I called, and so did my sister. I called my sister, and I called my brother. And I said, sell your bond funds. These were bond funds. Not bonds themselves. Bond funds, which rise and fall with the value of the bond. I called him about 2.5 months ago, and I said, I'm selling all of my bond funds, and I think you should as well. And my sister did, and I don't think my brother did. I haven't wanted to call him about it. And the reason was, as the economy, now I didn't get the timing right. Bonds went a little bit higher after I did that. But I did get the fact right. Because the economy clearly was improving. Maybe not much, maybe not substantially, maybe not at a very quick pace, but it was improving. It was clear from all the statistics. That meant that rates were not going to go any lower. And so it doesn't matter, really, from a bond point of view, whether you get the timing right within, a couple of months. It does matter that you get the fact right. And that's what happened here. Because all of the bond market players who own portfolios, but they're not holding the bonds to the term. They're trading the bonds. No. That as soon as it begins to move, as with all trading markets, he who jumps first makes the most money. And that's why we had such, I should have put up the 10-year, but I know I've done the 10-year a lot, so I don't want to do that anymore this time. So that's why we have seen such a dramatic move in all of the markets. What we're about now, the last point on what Mr. Bernanke did yesterday, or 2 more points. And then we'll talk about emerging markets. The economy is getting better in the U.S. How much better is debatable. The Philly Fed Index was out today, and it was much, much better than expected. But it's not that important, but still, it's an indicator. But nobody, including the Fed, has any real idea where we're going. The economy is a bit stronger, but the manufacturing indexes, especially the ISM reports, have been dropped below 50, expansion and contraction line. And even though the U.S. economy is only about 10 or 15% manufacturing these days, it still is used as an indicator for the overall economy because the lead times in manufacturing are longer and more is involved. So, it's not like if you're running an accounting firm, which is a service industry, and your business is expanding, you can go out and hire somebody. And that's all you have to do. And if you really need it, you can probably get it done really quickly, or you can hire a temp in 2 days. If you're making tractors, then you have to plan 6 and 8 months in advance at least. You have to have contracts for the steel, on and on and on. It's a much more complicated, much more lead time. So that's why manufacturing is still looked upon as a leading indicator for an overall service economy, which is what the United States is. So the manufacturing indices have been poor. If you look at the manufacturing jobs in the non-farm payrolls, they've been negative for 3 or 4 months now. This does not look like a really good sign for the overall economy. The Fed themselves just dropped their growth forecasts for 2013. They upped them for 2014. I don't think anybody knows what's going to happen in 2014. Look around the world. Europe is in recession. Yes, every once in a while you see a little twitch in some of the statistics, but it's still in recession. China. I was hoping to get to this today, but I doubt it. There seem to be far more serious problems in China. There is one fascinating thing I saw on Bloomberg today. Not only is China's manufacturing shrinking, but there was, let me just find this piece because I just want you to hear it. Headline in Bloomberg, PBOC, the People's Bank of China, set to add cash after China money rates jump to records. Now what does that mean? That means that the overnight money markets in China, that banks and others and corporations use to fund themselves, are having liquidity problems. This is exactly what happened in the U.S. This was probably more key than anything else to the frightening aspect of the first TARP program under the last days of the Bush administration. Many, many corporations and others and banks fund their overnight liquidity needs in the day-to-day cash market. You go out there, for one, you buy money for one night. Basically, that's what it is. They hired the money in, I think, Calvin Coolidge's phrase about European debt after the First World War. They hired the money, didn't they? It's an old way of putting it. But if those businesses and banks can't fund overnight, the whole system starts to fall apart because they're all in, how would you call it? They're not quite in default, but they're not meeting their capital requirements. So they're in regulatory default, if you will. That appears to be what's happening in China. So back to Mr. Bernanke. He has said that we're going to end QE because the economy is getting better. Yet you look around, and its improvement is, one, extremely moderate, to put it nicely. Two, in the United States itself, there are a number of conflicting forward-looking indicators. The Fed themselves have lowered their own growth estimates, and then you look around the world. Now, the U.S. is I think the largest trading nation by volume, but not by percentage of economy. It's relatively small compared to some of the others. Nonetheless, to think that the ongoing problems in Europe aren't going to continue to drag the United States along with them. The emerging markets, this is the emerging markets index. Now, granted, a lot of that is speculation, but a lot of it isn't. Because if you take a much longer view, the emerging markets have been expanding. They buy things from the United States. China could. Now, many commentators on China have been saying this for a long time. It's sort of like the clock. It's a broken watch works twice a day. So if you forever say China's going to crash, then assumingly sooner or later it will, so you're right, for which you'll get a lot of credit. Nonetheless, there do seem to be some very, very dubious and perhaps dangerous signs coming out of China. It's questionable whether Japan, the third largest economy in the world, is going to recover economically based on higher inflation and a weaker yen. Perhaps. I would say perhaps not. Japan is an exporting economy. It has to export to someone. One of the problems that China is having right now is that the yen is so much weaker that it's causing, and I think Japan is either the first or the second biggest trading partner of China. So if, despite the historical antipathy between the two countries, dating from the 20th century actually, so this is another problem for China. So you look around at all of these things. The recovery in the U.S. is weak. A number of the more reliable forward indicators are weakening or have weakened. Europe is in recession. Japan, it's very questionable that anything's going to go on in Japan. And 3, China, or actually 5. China looks to be in great problems. All of these things, yet Mr. Bernanke is saying that the U.S. economy is going to continue to improve, and therefore we're starting to end QE. I won't say there's a logical disconnect here, because maybe the U.S. economy will improve. The U.S. economy has often led the world. However, there are other possibilities as well. One of them, which has been spoken about by a number of Fed workers and Fed board members and others, and academics and others, is that QE has run its course as far as its efficacy goes. That it's tilting towards creating problems more than supporting the economy. Mr. Bernanke never said that. I don't think he ever will. But as I said in one of the pieces I wrote 2 weeks ago, U.S. house prices are up 10% year on year, and I'm sorry, but this does not make a lot of sense in the context of where the U.S. economy is right now. 7.6% unemployment. It's really probably about 9.3, 9.4. If you account for both the people who have dropped out because they're retiring and people who can't find jobs. Essentially no wage growth over the past several years. That does not sound to me like an economy that supports a 10% year-over-year house increase. Don't forget, a 10% year-over-year house price increase is one of the things, a couple of years, and you've got a bubble. So it's quite possible that one of the reasons behind Mr. Bernanke's and the Fed's move is that they actually that they think that may be one of the problems. That these excessively low interest rates, historically low, abnormally low, for years and years, do a number of things. One, they enable the federal government to spend all sorts of money, which it doesn't have, which the Fed then buys. Remember, the Fed's been buying 70% of the Fed Treasury issues. So the Fed is funding the government. This is not a sustainable path. And it's enabled by low interest rates and by quantitative easing. Because if you get rid of quantitative easing, then your rates will go up, which is what's happening now. So there's that possibility as well, that the Fed is has come to the conclusion, or partially to the conclusion, that quantitative easing is doing more harm than good, or has potentially more harm in the future, that it is permitting the government to run completely fantasy bookkeeping. I know lots of people will disagree with this, but this is my own particular view of it. And 3, there's one more factor, and then we'll look at the MSCI and emerging markets. And that is that Mr. Bernanke's term is up January 31st. He clearly is not going to be reappointed. He may keep as far away from politics as is humanly possible for a man in his position, but he can hardly be unaware of it or know that a different Fed chairman could lead the economy and the Fed in a different direction. The leading candidate right now is a woman on the Fed Board of Governors named Janet Yellen, and she is probably the most dovish person on that board, meaning more QE, more liquidity, forever. I don't know if that's forever, I exaggerate. But she clearly, at least been the judgment of journalists and others, I certainly don't know the woman, that she would be far more inclined to offer more and ongoing liquidity support for the economy. Irrespective of whether there are bubbles brewing or not, apparently she doesn't think that's that much of a problem or a potential problem. So, if the Fed puts in place for the next, it's now June, the next 7 months, a policy of tapering and then ending QE, it will be much harder for the Fed under a new chairman. And don't forget, 2014, we are running into a congressional election, and a new chairman appointed by President Obama, who has stated flat out that his goal politically next year is to retake the House of Congress and thereby control all two houses of the legislature and the executive. Will that be aided or damaged by a tightening? There's no sound? Hold on. A policy of continued quantitative easing. So it's quite possible that Mr. Bernanke thinks it's possible. I don't know if this is true. I don't know if this is how his logic works. But the fact of it is inescapable. That if the Fed under Bernanke does not start to end quantitative easing now, put that policy in place, it's quite possible, and makes sense logically, that a new chairman such as Janet Yellen would continue the policy, which may not be something that Mr. Bernanke, with his obviously doesn't since he's ended it, thinks is a good idea. So there's that possibility as well. So I was reading some stuff on that today about Mr. Geithner. I mean, can somebody, Tim here, I know the topic is emerging markets today, so I will talk about emerging markets. Okay, that's what I wanted to know. It was the topic today, and although the other stuff is fascinating, I think we need to at least deal with some of the emerging market issues here. Okay? Since after all, there are a number of people on the call who came for that reason, and I think that's correct. So let me do that. I don't think Timothy Geithner is going to be appointed Fed chairman. I don't think he wants to. I think he said that he wants to go to the private sector and make some money. Okay, well, I guess that's understandable. So let us look at the MSCI Emerging Market Index, or as I decided to rename it this morning when I got up, and it came to me in a flash of less than brilliant inspiration, but nevertheless I thought it was mildly humorous. I decided to rename it the MSCI Global Hedge Fund Investment Index. And the reason for that should be eminently clear from this chart. For the period that we're talking about, the period of the past year, The movements of money in and out or through the world financial system, and since we're talking about emerging markets, to emerging markets, has been dictated, predicated, determined by the Fed rate policy. If you cannot get returns at home, but you can borrow money at no cost, essentially no cost, and you're a hedge fund, what are you going to do with it? The Fed said that they're going to keep QE going. They didn't put a date on it, forever. So you at least think of a hedge fund guy running a fund back in August and September of last year. Suddenly the Fed says they're going to start buying all this money, start flooding the market with money again. As a trader, an international trader, where is this going to go? What has historically happened as the bull markets and also economic expansions get older in the developed world? The money goes to the riskier environments. And this is precisely and exactly what's happened here. Look where we are now. Look at this. Is absolutely fascinating. There is nothing that's going on here in this time frame that we're talking about, the last year. That's economic. This is trading. This is liquidity. This is money looking for a home. This is experienced professional traders looking around and knowing what's going to happen because they want to do it and everybody else is going to do it. Look where we are. On September 12th, when QE started, we were here in this MCSI fund. Now, I'm not saying, I exaggerate, but the biggest bulk of what's going on here, certainly on the rise, has been dictated by trading considerations, by investment searching for home, by money. We are now below where we were before QE started. Now, markets always overcompensate, and in this area right here, where we are now, not only has the Fed said that they're going to start withdrawing liquidity, so once these are trading reactions. Look at this. Look at this line right here. The day. This blue line right here is the 23rd. Look at that. Everybody piled out because they know that the reaction is going to be uniform around the world. Now, it doesn't mean that all the money invested in equity markets around in emerging markets equities is hot money, is trading. I mean, of course not. But it is enough to make the markets move. Let's take a look at some of the currencies at the same time. Okay? Now, I may not get to China today. I'd like to talk about China because China is a separate case, but we may not get to it. Let's take a look. Okay, so this is the Mexican peso. Now, the Mexican stock market actually peaked back in January, but this is the Mexican peso. I'll do the rupee in a second. The rupee in a second, then I'll do the rupiah. Okay, I have some of these figures here. So for the peso, from the bolsa, the Mexican stock market is right here. From May 22nd until now, whoops. May 22nd, sorry, is right here. It has fallen this much, but as I said, it peaked back in January. So the Mexican Bolsa is down 4.8%, 5% essentially since May 22nd, 17% since January, that peak in January, and the peso is down. I will show that. You mean IDR? Yes, I'll do IDRs. No, I'll do the Indian next. It's down 10% essentially, 9.9% since May 22nd. Let's take a look at the Indian stock market. I may have gotten, that's commodities. Where's the Indian stock market? Okay, this is the rupiah. Okay, this is the rupiah, the INR. What do we have here? Same thing. This is why I started with the MSCI index. I did not bring up the South African rand. I mean, I had 22 countries to cover, 21 countries to cover in the MSI, and I didn't bring up the Thai baht either. If I brought up every 22 countries, we would never get through here, 21 countries. So I just left those two out. But there is a similar pattern in fact, in the ZAR, it's probably worse because so much of the economy is gold dependent. It's a large part of the economy, and gold's getting trashed today, and has been for some time. It's below 1,300. When I came in, it was about 12.85, I believe. It's off $85 or $90 today. This is the Indian rupiah, and the fall in the rupiah. The Sensex is down 6.7% since the 22nd, and the rupiah is down 7 points. The rupee is down 7.6%, and I only did this because I'm trying to. The point that I'm making is related to the Fed and QE since May 22nd. So there is the second look at another one. Let me see if I can. I'm sorry. This is the Indian Stock Exchange, the Sensex. Sensex. Yes, Sensex. Sorry. So this is May 22nd here. And you can see, even with the gyrations, all of the equity for gold, I'm sorry, the reason I don't have support and resistance for the rupiah, the rupee today is because this was not primarily a currency presentation. So I don't actually have those. I'll take a look at the chart before we go and tell you what I think. But I didn't do this specifically as a examination of what the particular currencies are, but rather the economic effects of quantitative easing and the changes that were eminently predictable in all of the currencies once the Fed said what it was going to do. Okay, let's take a look at this briefly because it was requested, and I always like to answer my requests. The problem with this is I don't have a long enough period on this chart to determine where the support and resistance is. So I apologize for that. If you will give me your email, I will, when I'm done with the presentation, I will draw you my support and resistances on the rupee and send them to you. What I will do, how about this, so that everybody can do it. When I get back to my desk, I will go do a technical analysis of the Indian rupee, and I will put it up on our website. I will send it to you as well. Thank you very much. I will put it up on our Facebook page, Worldwide Markets, and on our blog, and you can see it there. So I will do that when I go back. I'll be very glad to do that. Let's look at another fascinating. This is Jakarta. It's been 4 or 5 years since I've been to Jakarta. Again, the same pattern in every of these currencies, and let's look at the Indonesian currency, the IDR, as it used to be called. I remember when this was actually one of the currencies I used to trade. Now, if you want to look for volatility, take a look at this. It's a much smaller currency, and you can see the tremendous volatility. I remember trading this thing. We were not as traders for a bank, for Credit Suisse, we were not allowed to take. Yes, that's true. We were not allowed to take positions in the Indonesian rupiah. We could quote customers, but we were not allowed to take positions in it. Take a look at the volatility in this. Now, interestingly enough, the rupiah has only devalued 2.2% from May 22nd till now. Yet the Jakarta index is down 11%. I don't know whether Mr. Soros is banned from Jakarta or not. I think he's rather busy now. He's at least 80, and he just got remarried. So he's probably kind of busy and needs to save his energy. But I don't actually know. And the woman is like 40 years younger than he is. Sorry about that, folks. It's still true, though. Anyway, so there's an interesting sort of dichotomy here, because one of the things that's true about, these are very simple equations as far as trading goes, which is why I really brought this up and this topic in the first place. Look at, let me finish with this first and then we'll talk about it. When someone goes to invest overseas, what do they have to do? Well, they take their dollars if they're American, and they sell the dollars and they buy the rupiah. And what does that do? It drives up the value of the rupiah. So, every time money goes to, I'll talk to that in a minute. There are two trends here in the emerging markets. So every time there is a flood of hot money, as it gets called. I don't really like the term, but it's pretty descriptive. And money now is much hotter than it used to be, because it's so much easier now than it was 15 years ago, 10 years ago, to fling money around the world. I talk about this particular aspect of trading almost every time I do a webinar. It's fascinating as to the changes that it's brought in the world economy and certainly in trading. So every time there's a flood of money into the emerging markets, two things happen. The stock markets go up, the bonds go up, the rates go down, and the currencies go up. But every one of these is dictated by the marginal funding. Now, and that is absolutely something that you can trade. Now, take a look at the Filipino peso, because I think that's a pretty good example. Okay, this is the Filipino peso. May 22nd, up to here. Now, what is the? Let me find the biggest mover in the. Actually, the biggest mover is the biggest mover in the emerging currencies that I looked at, and I didn't look at everything, is the Brazilian real. So let's take a look at the real. Now, if you can trade the real, this is an 11% move in the real. Now, there are other things going on in Brazil. Their recent part of this move right here is some of the unrest, the civil unrest in Brazil, which has been going on, I think, for about 2 weeks now. I'd have to check the time. I have an article here, but I'm not going to get to it. And I didn't bring up the Turkish lira, but that's the same thing that's going on in Turkey, and true for the Ankara Stock Exchange, which is now down, I think, 22%. Some of that has to do with the protests in Taksim Square across the Golden Horn. Istanbul being one of my favorite cities in the world, probably my second favorite city after the one where I live, which is New York. It's a beautiful and fascinating place, and well cared for in all of its historical monuments by the Turks and the Turkish government. Anyway, my little advertisement for Turkish tourism there. That was completely voluntary. Okay, so there are two trends going on in the emerging markets. One, of course, is the long-term trend of ascendant, because the economies are growing. The populations are growing. The biggest reason why stock markets go up is because this. I also didn't do the Russian economy, because it's so closely tied to oil that it has a different aspect to it. These other economies are more diversified, and they, I think, are more indicative as destinations for money that came out of the Fed's QE program, seeking homes. The Russian economy is, we don't actually, as worldwide markets, do any business there. We find it a little too difficult to do business. And we also have any local partners. So anyway, that's the reason I left the Russians out, and the ruble. So part of this, so there are two trends in emerging markets, of course. There is the long-term trend, which is indicative, which is part of the same trend that drives up every stock market. And that is that the economies grow, you got a higher stock market. That's the biggest reason behind the standard investment trope that stock markets always rise, and over time you will make money in the stock market. The biggest reason is because economies grow. And growing economies give you higher stock markets, higher averages, higher indexes. If you want to see what happens when an economy stops growing, we know where to look. We look at Japan. I believe the top in the Japanese stock market about a generation ago, almost now, was around close to 40,000. I can't pull it up here. So it is not true the stock markets always go up. They always go up under conditions. The reason it could be said for so long is because those conditions always and everywhere held since probably about 1950. It took the American Dow average, if I remember correctly, 25 years to get back to the peak. Now, these were pretty years where a lot was going on. To the peak of 1929, 39, 49, about 1953 or 54, if I remember, to reach that peak again. A generation. So since then, if you make the time frame long enough, stock markets have always gone up. But it is not an irrevocable fact. Okay, so the trend that's going on in emerging markets. And it's certainly a trend which is to the benefit of emerging markets. It's to the benefit of long-term investors in emerging markets. What we're looking at here, both in the currency. Now this, as I said in the real, is something you can certainly trade. Any of the events in the context of the time frame that I'm talking about are tradable. Now, as we just saw with the rupiah, there's a tremendous amount of volatility in these markets. This is a daily chart. But there is a amazingly tradable fact here. And the reason every chart that I bring up today is illustrated with May 22nd is because that was without, yes, absolutely it did. World War II did accelerate the chart. That I've written a number of columns. The last one I wrote, I think I called it the central banked world. And the reason I chose that, or that came to me, is because everything that has been going on in the markets post-financial crash, and certainly for the past year, is purely dictated by reaction to central bank policy. And that's why I have May 22nd on every chart. I'm going into the wrap-up here because I know the time is up, and FX Street has permitted me to run a little bit longer than usual, and I thank them for that. Mr. Bernanke's utterance about ending QE on the 22nd was as deliberate a statement as could possibly be had. It was, without question, a premier, maybe the premier, tradable event. And it has carried forth into almost every trading market. Now, commodities, which are another entirely different topic, an associated topic, that I'd like to deal with maybe in the next webinar. Commodities, I do have a commodity index here, and I just want to show it to you. Did I get it up? Let's see if it works. Okay, here's the commodity index. This is the worldwide commodity index. And you can see that the commodity index has been falling since September. Remember I showed you the Mexican stock market peaked in January? The reason for that is the commodity index. And if we had the Russian economy up there, it would probably be the same thing, although I don't look at it. They're much more closely tied to commodity prices. And so that, Mexico, of course, with oil. Okay, let me ask one of these questions here. Okay, one of the things that Mr. Bernanke, about the euro over long term, one of the things that Mr. Bernanke said was that, you know, and the markets completely ignored it, that if things don't improve, then we could always go back. Now, once they start ending or tapering off QE, yes, they could. If they go down to $20 million, $20 billion a month, and then they decide to go back, they could. But there is a real question, and it's a question that becomes increasingly important. Say some of the indicators that are slowing in the economy worsen, that there's far more effect on the U.S. economy than the Fed expects. And so that instead of growing 2.5% or 2% of the second half of the year, the economy grows 0.5%. What's the Fed going to do? Is it going to bring QE to $100 billion a month, to $200 billion a month? And what if they did, what would the effect of that be? Would it make any difference to the economy? Or would it simply do exactly what we have seen in the emerging markets and the emerging markets currencies and in other markets, including perhaps the U.S. housing market? It would drive a much stronger urge to inflate. Oh, so I'll answer that. The second trend is the trend that I've been talking about. There is a long-term trend in all the emerging markets, both in their economies, in their stock markets, and in their currencies, actually. And that is for improvement. In other words, the economies grow, the stock markets rise, and the currencies strengthen over time, long trend. And that is tied to population and to economic growth. A country that has a strongly growing population, other things being equal, tends to have a more strongly growing economy. And that relates and translates to, of course, the currencies. That's the longest trend. And that, barring any terrible and unforeseen circumstances, will continue. So that's the longest term trend, and I think that is as they like to say in the current jargon, a secular trend. The second trend in the currencies and in the equities of these countries is this trend right here. This is the one that is much shorter term, and it is almost purely a trading reaction, a search for yield, a trading movement predicated on the use of quantitative easing and the lack of real return, except in the equities, in the developed world. And of course, the reason for return in the developed equities is exactly the same as it is here. Because there is liquidity chasing return. May 22nd, the date of May 22nd on all of my charts is the date that Mr. Bernanke said that the Fed may begin tapering its quantitative easing program sometime in the next few meetings, meaning the next few FOMC meetings. That's the date that he said that. Not quite a month ago. And that has been the change in everything that we have seen since then. It was the change beforehand. This is QE3. This is QE4. Look at this. Shoots up, stable. Economy starts to roll over a little bit. People start speculating on more QE. They do more QE. This is what we see. So this is why I keep stressing this, because we're all traders. And this is a trading scenario that you can all participate in. Now, as far as where we go from here, I think that where we go from here is an interesting question. I don't think the Fed's going to lighten its portfolio. I really don't. Because what would be the gain? The Fed is not required to maintain any amount of liquidity. It's not like a bank where if the assets they have on hand go down in value, that they have to retain more cash. The Fed's not like that. I mean, their portfolio may be losing money, but who cares? It doesn't really matter very much. So I can't see any reason for the Fed to start trying to unload its portfolio. I think they're far more likely to let it run off. Because what would be the effect? If the Fed starts selling MBS paper, it'll drive down the value of that paper. It will then drive down the value of all the remaining MBS paper that's sitting on bank balance sheets. There's nothing good to come from that because they'll all require more liquidity. And the same is true with treasuries. If the Fed starts selling its treasuries, there'll be a couple of problems. One would drive rates up on treasuries. That will make the federal government that much harder to fund. It will also annoy, to say the least, holders of treasury portfolios around the world, other governments. Their portfolios will start to drop in value. So I don't think the Fed is about to do either one. Because if the credit markets so far have not taken fright at the idea of the Fed or the federal government in the United States issuing credit with one hand and paying it off with another, then I don't think the markets are going to have any real issue with the Fed not selling treasuries. So I don't think they're going to do that. That's okay. I thank you very much, Vicki, for letting me run over on this. It was appreciated, but I didn't know. I could not tell. I thank you very much for letting me run over. I hope this has been, I know we got a little afield here, but I hope, I'm certainly fascinated by this stuff. As you can tell, I've been doing it for 20 years and I'm still fascinated by it. I will put up, I'm going to do two things. I will put up a Indian rupee chart and I will put up a gold chart. I think gold is cooked for the time being. But I will put both those charts up on our Facebook page as soon as I construct them. I thank you very much, everyone, for attending. Those of you who stayed into your evening, that would be Asia and Europe, I thank you very much, and I am flattered that you attended. I hope this was useful. I hope it was entertaining at the very least. I will mail it to you as well. Again, FX Street, thank you very much for putting this on. I will see you all next month. Everybody take care.